All right, there we go. It's 6:04. We've let some more people in the waiting room. We'll go ahead and get started. Welcome, guys, to Homebuying 101. Thank you so much for joining us. My name is Erica Virgo, and thank you for being a part of Bright Star's seminar today, virtually. So thanks for taking some time out to get some good information about the home buying process. If you don't know who we are a full-service financial institution. We do everything, business, personal. We take care of all of your financial needs, and we are your community credit union. So if you ever want more information about Bright Star, you can visit bscu.org. That's got our whole product spiel and everything that we can offer you to improve your financial lives. We have a wonderful speaker for you guys this evening, our mortgage services manager, Manuel Cardenas. And he's going to give you the rundown from start to finish on the home buying process and answer any questions that you guys may have at the end. So if you do have questions, don't forget to put them in the chat. And we just want to thank you again, and I will let him take over.
Thank you, Erica. Good evening, everyone. Thank you for joining. We have a great presentation for you today that'll take you through some basic understanding of the home buying process, including mortgages, how to search for a home, what you can expect. So first, we're going to talk about preparing for home ownership, right? Then, like I said, some mortgage terms that'll help you kind of understand when you hear them, you understand what they are and what's expected of most borrowers. And then kind of like searching for a home, that's an important piece. And how to ensure that you have a successful search for a home. And then finally, once you've signed a contract for a home, you're approved for a loan, what you can expect at the end of the transaction and what it's going to take and what kind of costs will be involved. So moving on. So first, preparing for home ownership, right? So some basic terms, like I mentioned. So down payment. So in just about every transaction, you're going to need a down payment towards the purchase of the home, aside, in addition to some closing costs. So there's different types of programs, and it could range from 0% down for a VA loan, a 3.5% down from some of the affordable products, and you can put as much as you're able down payment. Just one thing, in the past, like 20% was required, very long time ago. And as the market went to strive for more home ownership, there are more and more products that allow you to put the lower down payments. So just one thing, that if you're putting less than 20% down, there is an additional cost on a monthly basis, which is called private mortgage insurance, which insures the lender the difference between the 80% that they're financing and above, right? So let's move on. Other terms to keep in mind is closing costs. So those are basically the fees that you will be paying to, first of all, get your loan and then do the settlement. So our lender fees, the lender's lender fees, attorney's costs, there's always a title attorney involved, and they kind of close on the transaction. They pull what's called a title search, make sure that once you own the property, you're insured, or you don't run any risk of someone else having a claim against that property. So for those services, those are costs. And then you have your taxes that you have to pay for the transaction, the county and the state. Of course, once they're cut, there's sales tax, if you will, and then some prepaid items such as your escrows for taxes, insurance, things like that. And then also, as your transaction is being evaluated, they're going to look to see, the lender's going to look to see if you have some reserves, meaning a little bit of cushion that once you close, you're not left without any money at all, that you have usually at least 3 months in reserves in case of an emergency. So that's something that lenders will be looking at in order to approve your loan. The next thing is credit score. Very important driver of not only getting approved, but what kind of rate you receive you're able to get on your loan. So the lenders will check your credit on all three. There are 3 credit bureaus. We'll look at all 3 credit bureaus, and then if there's either 1 borrower or 2 or 3, we will take the lowest of the middle scores. So for example, if 1 borrower has a 700, a 690, and a 680, and that is the lowest of all 3, we'll use that middle 680 to qualify the whole transaction. So the lowest middle score, that's what all lenders use actually for qualifying you for a loan. Many lenders, we're requiring about a 620 credit score at least. But once you get in the 700s, that's when you start getting a much better rate on your transaction. But no worries, if you're in the mid 600s, you can still qualify for a loan. We're looking at a credit score 620 as being like fair, and many FHA loans, that's what you need, or alternative affordable programs, that's what you'll need, a 620 in order to qualify. So, and next, kind of just to put it on perspective, like a quick look at credit scores. This is kind of scoring model. You have your poor, fair, good, very good, and excellent. Very good and excellent always get the best rates, but that doesn't mean that you're not gonna get a good rate in the good range. Even in the fair range, nowadays rates are pretty affordable. So that's kind of a look. And any time that you like, you're once a year you're eligible for requesting a free credit report. And then for the credit score, you might have to pay a nominal fee along with that. But you can pull your credit report at least once a year for free. We on here. So in the past, credit scores were a big mystery. Nobody really knew what went into it. You're like, okay, my credit score is 700. How do I affect it? It's 650. What makes it that, right? So here's kind of, you don't know specifically what goes into, but this gives you a very good idea. So whether you're getting a lot of new credit or not, that affects it 10%. Of course, if you're taking on new credit, a lot of new credit, it's detrimental to your credit score. That doesn't mean it's necessarily bad, but it doesn't help, right? Length of credit. The longer you've had a credit history, the better it is. And that's about 15%, makes up about 15% of your score. Usage, right? So let's say you have certain available credit lines. Are you maxed out on all your credit cards? Or do you have plenty of space there? Rule of thumb is on your trades, your credit cards and others, try to keep it under 50%, 45% of your total line. So it's better to have, let's say you have 5 credit cards, instead of having one at 100% usage and the rest at 0, it's better to spread that debt out so that no line go past 50%. That's ideal, right? That's ideal. That doesn't mean that's 10% of your credit score. Then, of course, the biggest part of it is your payment history. Just make sure that your payments are being made on time every single month. We see some little blemishes on credit, and that happens, but we try to keep that. You want to try and keep that to a minimum. And then your total amount owed is another large part. That's 30%. How much you owe compared to what you earn. So that's another important driver. Moving on. So some tips on good credit. So like I mentioned, always make your payments on time. Very important. If you have a collection, which happens, just paying those off. That really helps, not having any active collections. And once you pay them off, they don't affect your credit, right? So paying out your debt, like it says here, keeping balances under 30%. That's ideal, and that's overall balances. But per trade, 45% on your revolving, such as your credit cards, you want to keep it around 45% or lower. If you already have at least 2 to 4 credit lines, you're probably okay. No need to rush out there and get additional credit. Remember, I mentioned that it was 10% of your credit where your credit score, whether you're taking on additional debt. So you shouldn't be going out and making a lot of purchases, getting new credit cards when you're getting ready to qualify for a mortgage. Another thing is, I mentioned, I think it was, I don't remember the percentage right now, but it was a significant part, is how long your credit history is. So if you're going to pay off a debt, it's best to keep your older trade lines, your older credit cards active. Showing a longer credit history is best for your credit score. And then, like I mentioned again, excessive credit applications. When we pull credit as a lender at the start, if you see a lot of inquiries, that means that person is trying to bring in additional credit. They maybe have not brought it on yet, but that's their intention. So that can be detrimental to your credit score as well. So let's get into the mortgages themselves, right? Some key terms that we should focus on. So in the next slide, we'll see. So these are, like I said, some tips, right? When is the best time? So don't wait until you're like, oh my God, I love that home, I'm going to go and make an offer for it. And you haven't done anything yet to prepare from a mortgage perspective. You don't want to do that, because realistically, no seller will entertain an offer if you haven't already gone to a lender and you've gotten at least pre-qualified. So it's best for you to reach out to a loan officer way before you start your buying process. It's number one, to see what you can afford. And number two, when you go to make that offer, if you have a pre-qualification or a pre-approval from a lender, it gives you more buying power. It makes the seller feel more comfortable that transaction is going to consummate at some point, right? Most sellers, like I said, don't want to entertain an offer at all. And actually, most realtors will require that from you before they take you out shopping for a home, right? So there's two types. There's pre-qualification and there's pre-approval. Pre-qualification uses an automated approval process. A pre-approval actually goes to a live underwriter. But a pre-qualification is usually good enough for you to get a contract, right? Pre-approval takes a little longer. So you're going to wait 30 to 45 days to get that done, where pre-qualification, you'll probably get that in a couple of days, maybe the same day, if you're prepared when you have the conversation with your loan officer. And then those, whether it be a pre-qualification or a pre-approval, those are good for 60 to 90 days. But at the end of that, if you haven't found a home, you can refresh it. Just provide some fresh documents, income documentation, your assets, to the loan officer, and they'll refresh and they'll give you a new pre-qualification, right? But they're usually good for 60 to 90 days. So mortgage types. You have your typical, most common fixed rate conventional loans, right? Fannie and Freddie Mac. Then you have adjustable rate mortgages, which it's not for everyone, but for some borrowers, that mortgage works out pretty well. And it all depends how long you're going to be in your home. Adjustable rate mortgage, at some point, they will not be fixed any longer, and they'll adjust on a monthly basis. So you're subject to what interest rates are going to be in the future. When you get a fixed rate, it's going to be for the life of the loan. So, but there are occasions when an ARM would be the best for a borrower. And then you have FHA, which is an affordable product. Those carry the 3.5% that I mentioned. And then you have Veterans Affairs loans, VA. Those can be 0 down payment, but you have to be either an active military or a veteran in order to qualify for those. So application criteria, credit score and history. Okay, your income and employment history. We're kind of looking for at least 2 years of consistent employment. There are exceptions to that. So for example, if someone just got out of school and they've got a new career, we can prove school history towards that, as long as you're already actively, you've begun working in the career that you studied for. But typically we're looking for about 2 years of employment history. We're going to look at your existing debt altogether, and then we'll add on what your new mortgage will be, and we compare that to your income. And that is what's called debt to income. And you can usually go to as high as 50%. Ideally, we're looking for 43%. But in some products, you can go as high as 50%. And then your assets, we're going to be looking at that as well, which is what have you saved towards a transaction. I mentioned closing costs, down payment, reserves at the beginning. We're going to be looking for proof that those funds have been in an account for at least 2 months, or they can include gifts from a family member as well, which you can receive towards the end. So that's kind of what very important keys to what we look at in evaluating an application. Next slide, cash reserves. Like I mentioned, that little cushion that you want to have, that the lenders are looking for, which is typically it'll be at least 3 months of principal, interest, taxes, and insurance, and HOA that you want to have in reserves after you close your loan. Moving on. So let's go over I mentioned some of the government programs, VA and FHA. Those are government sponsored. So VA, like I mentioned, active military, no down payment really required. We can finance up to 100%. That's for active military and former military veterans. FHA, they're insured by the Federal Housing Administration. That's a division of HUD. And again, down payments as little as 3.5%. And then there are many cities or counties and states. In Florida, there are many. You want to maybe do your research if you think you can qualify for one of those programs. They're typically for first-time home buyers, and it's just help from the municipalities. They could possibly give you a grant totaling $30,000. It could be $7,000. That depends on the program, and they're typically help you to purchase your home, and they're forgivable after some period of time, typically 10 years. Meaning there's a second mortgage on your home for 10 years. You don't have to make any payments on it. And then after 10 years that you own your home, it goes away. So if you sell your home, you don't have to pay it back. If you sell it before that, then you do. That helps. Because it's really meant to establish home ownership in a community, which helps stabilize the community, make it richer for everyone else when you have home ownership. It's very important. Okay, sorry, I'm not navigating the clicker very well. So loan payments, you'll hear the term PITI. PITI is principal insurance, and I just mentioned a little bit earlier. Principal, which is what your payment goes to lowering your loan amount, what you borrowed. Then your interest rate, I, the first I, what that is the interest you're paying on those funds. And then taxes is what you're paying the state, county, right? And then insurance, what you're paying towards your hurricane coverage, flood, whatever it may be required for your home. So at the beginning of your mortgage, your earlier payments are basically all interest. As you pay every month, and a little bit more goes to principal, then a little bit more, and then more and more, and it keeps increasing. It comes to a point where more of your payment, you owe less, so more of your payment is going to reducing that debt, and less is going to pay the interest. And taxes and insurance, you can add it to your mortgage. So the lender collects it. It's called escrows, collects it every month for you. And then at the end of the year, they'll pay your taxes, your insurance. That's very helpful. Helps you. It's like a little savings account that you have with the lender, and they manage that for you. Or many times you can choose to just do that on your own, and just when the bill comes in for taxes and insurance, you pay it yourself. So that means you didn't have any escrows set up. So there's on the BrightStar website, there's some counseling sections that I recommend that you look at, and have some calculators, very helpful to calculate your pity. We're repeating. Okay, so what I just mentioned about the payments going mostly to interest at the beginning, that what reduces, and again, there's just a term that you'll hear, what reduces the principal that you owe is called amortization. You will get with your closing an amortization schedule that will show you exactly what every payment through the whole life of the loan, what part is going to interest and what part is going to principal. And you can actually request one up front, but you will get one of those at closing. You will see that in your closing package, and that's pretty exact. What it doesn't cover is your taxes and insurance, because of course that changes every year. It can be higher taxes, lower taxes, or higher insurance, lower insurance. And then in many, especially down here in South Florida, you'll be part of a homeowners association. So those dues, they're just meant for the upkeep of your common areas. Maybe some places include your lawn service, your pool, the association. So those are funds that we don't escrow for. You'll pay those directly towards your association, but they will be considered when we qualify you for the loan, because that will be a debt that you have every month. Moving on. So what happened next? So after collecting the documentation, evaluating your application, we'll get, like I mentioned, an initial electronic underwriting decision. Then after that, it will go to a live underwriter or two, and they will review your loan, and you actually will get either an approval, or your loan may be denied, and you'll be given reasons why, and your loan officer could probably help you. Hey, how do we fix this? Or sometimes it's a counter offer, like to a lower loan amount or something, a different product. But those can be the different results. But if you prepare well up front and you have a strong loan officer that really evaluates your application, you have a much better chance of getting approved, at the end of the transaction. So when you get your when you apply at the beginning, within 3 days, you're going to get a set of documents, and you're going to sign those called 3-day disclosures and send them back to the lender, whomever that may be. And your loan officer can usually walk you through those and explain what they are. And those, you'll have something called a loan estimate, which will costs that are involved. And that loan estimate could change later on if the transaction changed. But your last loan estimate, whether it be the first one, or if you get an updated one midway, when you may have a redisclosure because there's a change, that will pretty closely match to the document that you sign at closing, which is called the closing disclosure. Next. So I just covered the loan estimate. It's going to say how much you're borrowing, what your interest rate is. You may choose to lock your transaction, your rate, or float the rate, meaning not select the rate up front. My suggestion is always, if you're happy with the rate and it works for you, don't gamble. Go ahead and lock it. And you have a rate that you like and works for you and you qualify. That's the best Many times I've seen people that, unfortunately they gamble and rates go up and then they're not eligible for the same loan amount that they were. So my suggestion, is your choice as a borrower, but if you're happy, why not? Go ahead and I would suggest you lock it. And then it covers your finance charges, your payment, what it will be, late payment policy, and your prepayment policy. All those things will be in your loan estimate and all of the other documents you receive at the beginning. So you've been pre-qualified. We haven't gotten to the full application process yet. So here's some tips on searching for a home and making an offer, right? So realtor, enlist the services of a realtor. The commission for the realtor is paid by the seller, not by you, the buyer. So you want a professional helping you negotiate. It's a tricky market out there. You want a professional negotiating on your behalf. So you always want to enlist the services of a realtor. Determine what your wants are and what your needs are from a new home ahead of time, so that when your realtor interviews you for the first time, so they can know what to look for, you should have an idea. Hey, I want something near these schools or in this area, or I want it with a pool, without a pool. I want an attached home, a condo, a single family. So have a good idea of what your wants and needs are. Then you get pre-qualified, and then you go out with your realtor. They show you homes. You find one that you like, and you make an offer. That offer may or may not be accepted because there's usually others interested in that home. Don't be discouraged. Usually the first home you make an offer on, it's not the one you end up buying. So many times it is, but don't be discouraged if maybe your first offer or second or third could be does not get accepted. You'll eventually find the home, and you have, like I said, bargaining power because you've been pre-qualified. Once your offer is accepted, right, you're going to have a few days that's called the inspection period, usually 5 to 7 days, sometimes a little longer, where you should enlist and your realtor will help you with that, a property inspector to go out and take a look at the property and see if there's any hidden issues that you, as a borrower, just from looking at the home initially, haven't determined. So they'll look at all of the appliances, air conditioning, the roof, they go through that house with a fine-tooth comb, and they'll give you a report, and then you can determine how you want to proceed. But during that period, you can actually you've given a deposit when you make your offer. If there's issues with the home that you cannot deal with or you can't negotiate with the seller, during that inspection period, you can always cancel your transaction and get your deposit back. So then once you go to your inspection, then you're kind of waiting for the final approval on the loan and for a closing date. So when that loan is approved, you get a decision from the lender, and you're saying, they give you a closing date, or you select a closing date. What you want to do is that day or the day before, you want to do what's called a walkthrough through the property. Make sure that everything that you negotiated is still there, such as appliances, that all of a sudden there aren't broken windows or issues that you didn't expect that could have happened between the inspection and the walkthrough. So very important to make sure you do the walkthrough like the same day or the day prior to your closing. Next. So your closing, that's the day that you go to your attorney's office, or it could be done online nowadays with the pandemic, and the house is transferred from the current buyer, from the current owner to your name, and the title attorney or the title company receives the funds from everyone involved. So your down payment and the lender's funds, and they distribute it to the seller, to the realtor, their commission. They pay off taxes, everything that has to be taken care of, so that when you receive your home, everything is good. You don't have to worry about debt against the home or liens or anything like that. There's going to be a lot of paperwork to sign, so be ready. Bring your signing hand in good shape. But your title attorney, your closing agent, will walk you through all of the documents. Do not be afraid to ask questions. I prefer when I go to a closing with a borrower, I like it when they ask a lot of questions. Very important that you feel comfortable about every single document that you're signing. I mentioned that they collect the funds. So if there's funds coming from you for the down payment, they're gonna require a wire transfer, a cashier's check. Typically, 99% of the time, there's gonna be a wire transfer. So the day of your closing, you're gonna know what you need to bring to closing. You go to your bank and you send a wire over to the closing attorney. So I mentioned the loan estimate and the closing disclosure. So here it is. So at least 3 days prior to your closing, you will receive your closing disclosure. And what you want to do is you want to match that up against your loan estimate, at least the last loan estimate. And there should be very little fluctuation. There may be some changes in your prepaid interest, depending on the day you close. There might be a little bit of interest difference in how much is being escrowed for taxes or collected, because that is also time sensitive to your closing date. But the fees itself, the general sections with the fees and the interest rate, they should not have changed much. A couple of dollars here and there, but it can't change very much legally, right? So you want to compare those two and review those with your loan officer in detail. Go through every single line. Again, ask questions. And if there's any variances or anything you don't agree with, bring it up. And there shouldn't be, though, because it's not legal to change those between the LE and the CD. So you're going to sign mortgage note. That's one of the main documents you sign. The mortgage is basically what you owe the bank, a promise to pay the bank or the lender for the funds you're borrowing. The deed of trust. The deed of trust is what transfers the title of the property to your name from the previous. You'll be signing that, as well as the seller will be signing that. And then again, the final closing disclosure that you get at the closing table, it's called the settlement statement. You'll be signing that, and that one will include not only your fees, but the fees of the seller as well. Moving on. Okay, so I guess so. If you choose to go with Bright Star Credit Union, we have great rates. We have low fees as a credit union. Remember those taxes that I mentioned? As a credit union, our borrowers, our members, do not have to pay what's called intangible tax. So there's doc stamps and intangibles. Those are two taxes that you pay the county as part of the transaction. If you go with a credit union, you do not pay intangible. So that saves you a couple $100 at least. So very important to know that, because if you're comparing between a bank or another type of lender and a credit union, that typically you won't notice. Definitely the bank won't tell you about it. So, but the credit union will point that out. So here are some ways to apply with us. That's your initial application, very, very simple online application that goes over to our loan officers, and then they start the process from there. And now I believe I'm turning it back over to Erica. To close it out.
Great. Okay. Thank you guys so much. And thank you, Manny, for giving us that whole rundown. For anyone that is attending from Pembroke Pines Charter Schools, you can scan this code with your smartphone and it will pull up your flyer for your attendance so that it can be marked. I will also, after we answer some questions from the chat, I'll put the link. If you don't have a smartphone or you don't have it on you, I'll put the link that you can click that will take you to the same form. So that way you guys will be taken care of. We do have some questions. I'm going to start at the top. First one, does your FICO score matter?
Most definitely. As I mentioned, there was a few slides on it. On FHA loans, the minimum is typically 620. The higher your FICO, some other products require higher FICOs. And the higher your FICO score, which is equal to credit score, the better interest rates and terms that you receive. So definitely a very important part of your transaction, of your qualification.
Okay. Next one, pre-qualify versus pre-approval. Are they both hard inquiries on your credit?
Yes. We're going to pull your full credit report in order to remember that pre-qualification is a electronic underwriting, but it still takes into consideration your debt, right, and your income. So we're going to look at your credit report, which shows all of your debt, and we're going to gather your income to make sure that when you compare debt to income, that you're in line. And we're also going to gather your bank statements and your employment history. So yes.
Good to know. Okay. Can we use retirement account balances as assets?
You can.
Okay, great. Does Brightstar offer pre-construction loans?
We do not offer construction to perm.
Okay.
That's like a niche. There's some lenders that offer that, very few. Most major lenders and credit unions do not offer, but a simple Google will probably find you someone that does it.
All right, the next one. Sellers are required to disclose any assessments on the property, correct?
Sorry, repeat that again?
Sellers are required to disclose any and all assessments on the property. Is that correct?
Not only are they required, but the title company will do the search and they'll find it. So when you remember that attorney I talked about that's charging you fees to do their work, part of that is looking through the public records and your title, and not only making sure that there are no issues, anything owed, they're going to make sure that it's paid and that they insure your title so that once you own the home, if anything pops up from the past, you're insured against it.
Okay, I see. The next one, are the inspections, so I guess the home inspections, private? If this is the case and I pay for the inspection, assuming I'm waiting for the loan, and I guess I find out that I'm not approved, seems like I'm losing money. Is there a way to minimize this risk?
So we don't require an inspection. Lenders don't require an inspection. That's for your protection. So whether you choose to do an inspection or not, when we do the appraisal of the property, right? They go out and look at the property itself and measure, and they're gonna get a pretty decent idea of the condition of the home. Very good idea. But they're not gonna be opening taps, and they're not gonna be taking the pressure readings on the air conditioning unit or things like that. They're not gonna go into those. That's something that your inspector does. So it's for your own protection. You can waive an inspection. That is a good advice to have one done. They're not that expensive. I mean, they're a couple of $100, but at the end, you don't want to close and then find out that your air conditioner is 25 years old and it has very low pressures, and you got to replace it a month after you closing your home. So the inspector kind of goes into really, like I said, fine-tooth comb. They go in the attic, make sure there's no leaks, that you have the proper insulation. So that's something that the appraiser will not necessarily figure out. So I will highly recommend it.
Okay, we do have some more. How would applying for a PPE loan affect your ability to purchase a home?
Applying for a PPE loan?
Mm-hmm.
Not sure.
payment protection or for businesses or
Oh, PPE, the business, that is okay. So that's going to be under the business unless you're like a sole prop. And then that will be, if it's done, if you get that loan in your name and appears on your personal credit, it will impact you. For generally PPEs they do not affect you on your own personal credit. It's typically towards the business that you own. But if it is in your credit report, yeah, we'll count it.
okay. The next one, who pays closing costs? I believe you said it, but if you could say it again.
So there's a lot of closing costs, right? Some are paid by the seller, some are paid by the buyer, and some you may negotiate with your seller to pay some of your own closing costs. You may pick a program that pays some of your closing costs, a loan program. So the answer is both seller and buyer, and sometimes the realtor might kick in some funds, right, to make the transaction go if you need help. And sometimes the lender will have a program that pays some of the closing costs.
Okay. What credit score is most important to look at out of FICO, etc.?
So we pull what's called a tri-merge. The tri-merge is all three credit reporting agencies, and we'll take the middle one. Whatever of those three is the middle, we won't use the lowest, we won't use the highest, we'll use the middle. And depending on every individual borrower, it could be any one of those three credit reporting agencies.
Okay, a few more. I'm just trying to make sure there's no repeats. How does including tax and insurance in the mortgage impact the cost of the mortgage?
Does not. Is like I mentioned, escrow accounts are a separate, let's call it like a savings account. So when the lender receives your payment every month, they'll reduce the balance of your loan, they'll pay the interest, and then they'll put your escrows aside in an account. Doesn't affect anything. At the end of the year, when you get your tax bill, you get your insurance bill, they'll pay it for you.
Okay. We're popular. You got a few more questions.
That's good. I like questions.
Yeah, good.
People are paying attention.
Exactly. What are the current interest rates for home loans?
Ooh. So generally, purchases are into the mid 2s to low 3s. But again, it depends on how much you're putting as a down payment, what your credit score is, what program you're participating in, and then what points you're paying or not paying. So you can choose a slightly higher interest rate and receive funds to help with your closing cost. Or you can bring additional costs, additional funds into the transaction and get a lower rate. Or you can do neither, right? So that's where you'll hear points, the term points. Points could be either you're receiving funds, and points is a percentage. So it could be like a quarter point, that is of the loan amount. So you could be receiving a quarter point, you could be paying a quarter point, or it could be no points involved. So that kind of affects the interest rate you get. So that's kind of a general question. But I would say between the mid 2s to the high 3s, sorry.
Okay. So since you just explained that, this is kind of the same. So for Roberto, you are kind of going to get the same answer. What kind of mortgage rate should a borrower expect if they have good credit, fair credit? So I believe you just explained that. Yeah. I'll go to the next one. Do you have a list of cities that have first-time home buyer programs?
We do, yes. We have, so there's programs where many cities, like there's a Broward, for example, program where there's 8, 9, 10 cities that participate. And then there's other cities that have their own. And then the county, so there's plenty out there. I don't have comprehensive list of every single program, but we do have lists of some programs that are out there that several cities participate in. The best thing to do is reach out to every city has a department that deals with that. So if you're looking in Cooper City, reach out to Cooper City and say, hey, what home buyer grants do you have for first-time home buyers? And they'll kind of go through it. So usually most folks starts with a general idea where they want to move, not move where they're getting necessarily grants. So, but you can call around. But we have a list. We have a list of several powered programs.
Okay. And I believe you talked about credit. You did talk about credit score and things that affect it. Someone's asking, how does bankruptcy affect your score?
So bankruptcy will affect your score. Now, if it's a Chapter 11, you're going to have to be out of your meaning that it was settled at least 7 years. If it's a Chapter 13, the bankruptcy must have ended at least 2 years. Now, there are some exceptions. So if there are extenuating factors to that 7 years, such as severe illness, or there's a list of some things that are considered, that you may be able to reduce that time before you can buy a home. But it does have a heavy impact. But as time goes on and you reestablish your credit, then it starts having less impact. Reestablishing your credit after bankruptcy is the most important thing. But we do plenty of loans with folks that have had bankruptcies in the past, and they have excellent credit score now, right?
Okay. I will say, for some of you guys that are asking really personal, detailed questions in regards to your scores and your situation, I would advise you to email. I'll ask Manny what email would work best, because some of these are a little more personal than for sharing. So I'm going to pass over those. But could you provide your email or best contact?
So I think the best way, so we have 3 local loan officers that will probably be the best, because they'll be able to get back to you quickly. I am covering a lot of areas, so I may not get back to you quick enough, and you deserve a quick answer. So if you go to our website, under mortgage loans, you'll see 3 pictures of Rosa Crespo, John Donahue, and Renato Silvestri. Those are our 3 local loan officers. Renato and Rosa speak Spanish. John does not, but he speaks English. And there's their email addresses and their phone numbers, and feel free to reach out to them with questions.
Perfect.
Reference this meeting.
And that's bscu.org/mortgage. So if you go on bscu.org/mortgage, you can directly email or contact one of our representatives about the really specific questions. Yeah, okay, we have just a few more general, and then we will wrap up. During the home inspection period, can you cancel if you find a problem? Can you also back out if you're not happy?
Oh, there you go. Those are the 3 pictures. Who did that? So during that, so it's all depends how your contract was written. So that's a conversation that you'll have with your realtor, and you can amend and change tweak your contract in many, many ways, right? As long as the seller accepts it. So typically during your inspection period, you can back out.
Okay.
Typically, right? But again, it all depends on the contract. There are 3 beautiful loan officers. There's all of their information right there.
Perfect. All right, I'll do about 2 or 3 more. Will consolidating student loans be beneficial as far as getting pre-approved for a loan?
Student loans, we calculate the payments. So if consolidating student loans reduces your overall payments, then yeah, it would be helpful. If the payment stays the same, it doesn't really matter. You can have student loans in deferment still, and then we use a certain percentage that we have to take. So the whole student loan calculation is a little complicated. The guidelines, I'm not going to go into them right now. The agency guidelines on those, different ways to calculate them, depending on when whether they're deferred or they're actually paying. Are you reducing that debt? So there's different ways to calculate that. But typically, the lower, the better, because it's less counting against your debt.
Right.
Against your income, sorry.
Right. Who is present at closing? I am a co-signer. Do I have to be present as well?
So present. So nowadays, a lot of closings are done virtual. No one goes anywhere just because of COVID. But let's go back to a year and a half ago. Typically, at a closing, you'd have all of the buyers. Co-signer is a buyer, and you'd have your title attorney who's closing your loan, or their representative, the closer. And sometimes your realtor, sometimes your lender will come if you ask them. Hey, sometimes they just, like I like to go on behalf of the credit union as often as I can, and so do my loan officers back then, right now. But typically that was it. Realtors used to go all of the time. Now they get paid electronically, so they're with first-time home buyers. Some realtors are sensitive to it being your first time, so they're there. But sometimes the seller goes like in the morning and the buyer goes in the afternoon. Sometimes everybody is there, seller, buyer, but then that just slows everything up. So typically, you're as a buyer, you'll show up and there'll be a closing agent, and all the borrowers, whoever's signing is going to be there. Or there might be a remote, half in person. So let's say one of the borrowers is in New York. They could do it virtually or remotely, and then the person who's here could do it personally.
Okay. All right. This is the last one we're going to do. And please, please, please reach out to those representatives so that you can get your other personal questions answered. Does marital status matter to married people buying a home versus to unmarried? Is there a huge difference?
No, it does not. To married people, remember, we're going to calculate income and debt. So if you bring your income, the second person brings their income into the transaction, they're also going to bring their debt. So it doesn't matter whether you're married or not, or whether you're buying together unmarried. It just depends. It will just change some of the documentation that you sign. But for qualification purposes, does not.
Okay. And I do want to mention or answer this as well because it's important. She says, I moved from South Florida to Orlando and I'm still a member with another credit union. Can I still apply? Yes, you can have more than one credit union. So please feel free to check out Brightstar and apply with us. That is a definite yes. And for everybody else, please, if you really have a burning question, reach out to our representatives. But thank you so much, Manuel, for your time and your effort. And thank you all for tuning in. And hopefully you got something really beneficial out of this. And we just want to thank you for joining us tonight.
Thank you all. Thanks for joining.
Have a great evening.
Bye-bye.